The following presentation is intended exclusively for educational and entertainment purposes and does not constitute professional financial, legal, tax, or investment advice. Auto financing, credit management, and the acquisition of debt involve inherent risks and complex legal agreements that vary significantly by state, local jurisdiction, and individual financial circumstance. Historical trends in the automotive lending market, average interest rates, and vehicle depreciation models do not predict future economic conditions or guarantee any individual rate offerings. Viewers are strongly advised to conduct their own comprehensive due diligence and consult with a certified financial planner, fiduciary, or licensed legal professional before signing any legally binding contracts, vehicle purchase agreements, or loan documents. The case studies, statistical references, and potential outcomes discussed in this presentation are for illustrative purposes to demonstrate mathematical concepts and industry practices, and your specific financial outcomes will depend entirely on your personal credit history, documented income, and negotiation strategies. Right now, as you are watching this, millions of everyday Americans are driving around in a rapidly depreciating financial time bomb. According to recent economic case studies and automotive market data, the average monthly payment for a newly financed vehicle in the United States has violently shattered historical trends, crossing the unprecedented and staggering threshold of $700 to over $1,000 a month for a standard, non-luxury vehicle. But that is not even the shocking part of the current economic landscape. The truly terrifying reality is that an estimated 30 to 40% of all drivers with an active auto loan are currently heavily underwater on their vehicles. That means they owe significantly more to the lending institution than the physical metal, rubber, and glass sitting in their driveway is actually worth on the open market. You might assume this catastrophic financial situation only happens to irresponsible buyers purchasing exotic luxury sports cars they cannot logically afford, but the empirical data tells a completely different, much darker story. This negative equity crisis is happening by the millions with standard commuter sedans, family minivans, and mid-sized pickup trucks. Let us examine a highly detailed case study that plays out in thousands of auto dealerships across the country every single weekend. An average consumer, let us call him David, walks into a dealership looking for reliable, safe transportation for his family. Because of a lack of financial education, he focuses entirely on a single highly manipulated metric, the monthly payment. He explicitly tells the salesperson he has a strict budget and can only afford exactly $500 a month. The dealership enthusiastically agrees to meet his target, shaking his hand and congratulating him. But to hit that $500 payment on a $35,000 vehicle, the finance manager stretches the loan term out to a grueling 84 months at a 9% annual percentage rate. What David does not realize in the excitement of the showroom floor is that over those 7 years, he will pay nearly $12,500 in interest alone, bringing the total cost of the car to almost $50,000. And because vehicles are rapidly depreciating assets, often losing up to 20% of their retail value the exact second the tires roll off the dealership lot and into the street, by year 3 David will owe $28,000 on a car that the open wholesale market values at only $18,000. He is effectively trapped in a cycle of debt. If the car is suddenly totaled in an accident, or if he faces a medical emergency, loses his job, and needs to sell the vehicle to liquidate assets, he is legally on the hook for a $10,000 negative equity gap that must be paid entirely out of pocket. How did the standard American transaction of buying a car turn into a systematic debt trap that consistently destroys wealth building for the middle class? There is a highly specific, psychologically engineered workflow happening behind the closed doors of the dealership finance and insurance office. They utilize a proprietary negotiation framework designed intentionally to obscure the true mathematical cost of the loan by compartmentalizing the retail price of the vehicle, the wholesale value of the trade-in, the down payment, and the interest rate into a confusing multivariable matrix. Later in this masterclass, I am going to reveal exactly what that matrix looks like, how to decode its hidden variables in real time, and the exact mathematical formulas you must run on your own financial calculator before ever handing over your driver's license. If you do not know how to identify and bypass this system, you are essentially walking into a complex financial trap entirely blindfolded. The objective of this deep dive masterclass is to completely dismantle the intentional obscurity surrounding auto loans in the United States and provide you with a bulletproof, fundamental understanding of automotive finance from the ground up. By the end of this presentation, you will understand the exact mechanics of how a loan is originated, underwritten, securitized, and amortized. This is not about sharing vague budgeting tips or minimal frugality advice. This is a rigorous technical breakdown of the multi-billion-dollar auto lending industry and your specific position within its ecosystem. We are going to directly solve the ultimate problem facing American car buyers today: the profound and costly asymmetry of information between the dealership, the massive lending institutions, and the individual consumer. Right now, the dealership knows the wholesale auction cost of the vehicle. They know the buy rate, which is the lowest base wholesale interest rate the bank is actually offering based on your credit profile, and they know the precise maximum legal limit they can mark up that interest rate to line their own pockets through dealer reserve. You, on the other hand, only know the heavily inflated sticker price on the window and the monthly payment they slide across the desk on a piece of paper. We are going to permanently level that playing field. You are going to learn the critical foundational difference between simple interest auto loans and precomputed interest auto loans. This is a technical distinction that can mean the difference between successfully paying off your debt early to save thousands in interest, or discovering too late that your early aggressive payments went entirely toward predetermined bank profits with zero benefit to your principal balance. We will explore the absolute mathematical necessity of securing independent financing through local credit unions or national community banks prior to ever setting foot on a dealership lot. This single strategy immediately shifts the leverage from the seller back to the buyer, turning you into a cash-equivalent customer. I will walk you through the precise impact of your FICO Auto Score, which is a highly specialized credit scoring model that differs significantly from your standard consumer credit score used for credit cards. We will analyze how lenders use specific tier systems, ranging from superprime to deep subprime, to categorize your exact risk profile and determine your borrowing costs. Furthermore, we will meticulously dissect the add-on products systematically forced into the final loan document, such as extended powertrain warranties, guaranteed asset protection coverage, tire and wheel insurance, and heavily marked up ceramic coating packages. We will evaluate these items not through fear or emotion, but through cold, hard mathematics and historical trends of utilization. This will allow you to determine which, if any, offer genuine risk mitigation versus pure, unadulterated dealer profit. You will see firsthand how rolling a seemingly minor $3,000 warranty into a 72-month loan at a 10% interest rate actually costs you exponentially more over the life of the loan due to the destructive nature of compound interest working against you. We will physically map out an amortization schedule, examining exactly how your very first payment might be comprised of 70% interest and only 30% principal reduction. This specific calculation reveals exactly why trading in a car during the first half of a standard loan cycle is mathematically devastating to your net worth. We will also examine the severe realities of the subprime auto market and the dangerous mechanics of buy here, pay here lots, where historical trends show default rates are built directly into the exorbitant pricing model. This comprehensive guide is systematically designed to transform you from a passive, vulnerable monthly payment buyer into an informed, strategic, and mathematically grounded negotiator. The automotive loan industry relies heavily on consumer impatience, emotional decision-making, and financial illiteracy. They deeply depend on the psychological exhaustion that inevitably sets in after hours of sitting in a sterile dealership waiting room. By equipping yourself with the detailed market data, historical economic context, and highly technical vocabulary we are about to rigorously cover, you protect your future household income from being silently siphoned away by depreciating metal. The long-term wealth you build in the future is directly tied to the toxic debt you strategically avoid today. And understanding the true, underlying mechanics of car loans is one of the most vital financial defenses an American consumer can possess. To truly master this defense, we must immediately tear apart the standard auto loan and expose its three fundamental molecular components. These core components are the principal balance, the annual percentage rate, and the loan term length. Every single financial disaster in the consumer automotive space originates from a fundamental misunderstanding of how these three independent numbers mathematically interact with each other in real time. Let us begin by examining the principal. Most consumers falsely believe the principal is simply the advertised sticker price of the car they see sitting on the dealership lot. This is a critical and expensive error. The principal is the absolute total amount of money you are borrowing from the lending institution, and by the time you actually reach the dealership finance office, this initial number has violently mutated into a much larger figure. Consider a detailed case study set right now in the current economic landscape of 2026. Sarah is an average American professional living in the state of Ohio, who desperately needs to replace her aging commuter sedan. She visits a local dealership and finds a reliable, mid-size sport utility vehicle with a window sticker price of exactly $28,000. Sarah builds her entire monthly budget assuming her loan principal will be exactly $28,000. She is completely wrong. First, the finance manager must add the mandatory state and local sales taxes, which in many regional jurisdictions hover around 7 to 8% of the purchase price. That calculation instantly adds over $2,000 to her debt. Next, the dealership legally applies state-mandated title and registration fees, plus their own internal corporate documentation fee. Based on historical trends in 2026, these documentation fees can legally range anywhere from $150 to nearly $1,000, depending entirely on the specific state regulations where the purchase occurs. Finally, because Sarah does not have a large cash down payment to absorb these heavy initial transaction costs, the dealer happily rolls every single fee directly into the loan. Her $28,000 vehicle just became a $31,000 principal balance before the engine has even been started for a test drive. This brings us directly to the second and most destructive component of the financing equation, the annual percentage rate, commonly referred to as the APR. The APR represents the absolute true cost of borrowing that money, expressed as a comprehensive yearly rate. It is mathematically crucial to understand that auto loans in the United States typically utilize a simple interest formula that continuously accrues on a daily basis. To understand your exact daily cost of existing in this specific debt vehicle, you must use a precise mathematical formula. Daily interest charge equals 365 current principal balance times annual interest rate. Let us run the exact mathematical calculations for Sarah using this formula. If her heavily inflated $31,000 principal carries an 8% annual interest rate, we first convert that percentage to a decimal, which is 0.08. We multiply 31,000 by 0.08 to calculate $2,480 in projected interest for the first year. We then divide that total by 365 days. This calculation reveals that on the very first day of her auto loan, Sarah is paying roughly $6.79 in pure, unrecoverable interest. When she proudly makes her first monthly car payment of $500, over $200 of that payment instantly vanishes to cover the accumulated daily interest of the previous 30 days. Only the remaining fraction of that payment actually goes toward reducing her massive $31,000 principal balance. This heavy interest waiting at the very beginning of the loan cycle is a foundational banking concept known as amortization. Now imagine if Sarah decides she needs to stretch this loan out to lower her monthly obligations. This leads us directly to the third and final component, the loan term length. The term length is the legally designated amount of time you have to repay the lending institution in full. Historically, a standard responsible auto loan lasted 36 to 48 months. However, in 2026, as vehicle prices have escalated rapidly across the nation, regional banks and national dealerships have aggressively normalized 60, 72, and even terrifying 96-month loan terms. Stretching a car loan across 8 full years is a mathematical catastrophe because it fundamentally ignores the physical reality of automotive depreciation. Consumer vehicles are not real estate. They do not appreciate in value over time. They are rapidly decaying industrial machines constructed of depreciating metals, complex plastics, and highly sensitive electronics. Let us deeply analyze the potential outcomes of manipulating this term length. If Sarah takes her $31,000 principal at 8% interest on a historically standard 48-month term, her monthly payment will be roughly $756. The total interest paid over those 4 years will be about $5,300. But Sarah tells the finance manager she desperately needs a lower monthly payment to fit her current lifestyle expenses. The dealer enthusiastically agrees and extends her loan term to 84 months. Sarah is absolutely thrilled because her payment dramatically drops to just $483. But let us look at the brutal mathematical reality she just legally signed up for. Over those 84 months, she will now pay nearly $9,600 in pure interest to the bank. By seeking a smaller monthly payment, she just silently increased the total cost of her exact same vehicle by over $4,000. But the financial destruction does not stop with the interest payments. Because Sarah extended the term to 7 years, her principal balance decreases at a painfully slow, incremental rate. At the exact same time, the physical market value of her vehicle is plummeting according to standard industry depreciation models. A brand new vehicle can easily lose up to 20% of its retail value in the first 12 months of ownership, and roughly 15% each subsequent year. By year 3 of her extended 84-month loan, Sarah will still owe approximately $20,000 to the lending institution. However, the wholesale auction market value of her moderately used, 3-year-old vehicle will likely have dropped to a mere $14,000. She is now hopelessly trapped in a negative equity position of $6,000. Imagine if, in year 3 of this exact scenario, Sarah is driving to work on a rainy Tuesday morning and gets into a severe collision. The vehicle is completely totaled and towed to a scrapyard. She naturally assumes her comprehensive auto insurance policy will step in, make her financially whole, and completely erase the bank debt. This is another catastrophic consumer misconception. The auto insurance company is only legally obligated to pay out the current actual cash value of the vehicle at the exact moment of the accident. The insurance adjuster determines the actual cash value is $14,000 based on local market depreciation data. They send a check for $14,000 directly to the lending institution. The bank applies this to Sarah's $20,000 principal balance. The insurance company permanently closes the claim, completely satisfied with the transaction. But the lending institution is absolutely not satisfied. Sarah still has an outstanding, legally binding balance of $6,000. Because the physical collateral protecting the loan is now sitting in a scrapyard crushed into a cube, the bank instantly converts that remaining $6,000 into an unsecured personal debt, and it becomes due and payable immediately. If Sarah does not have $6,000 in liquid cash sitting in her checking account to hand over to the bank, she will face severe legal and financial consequences. The bank can send the debt to aggressive collections agencies, severely damaging her credit profile, or they can pursue legal action to systematically garnish her future wages. She is now literally paying hundreds of dollars a month for a car that no longer exists, while simultaneously needing to secure financing for a brand new replacement vehicle with a newly damaged credit score. This is the precise, life-altering danger of the 84-month loan term intersecting with aggressive vehicle depreciation. This is the exact hidden mechanism that systematically destroys middle-class wealth in America every single day. Thousands of consumers sign contracts heavily weighted with severe negative equity, assuming the lending institution is simply offering them the best possible mathematical arrangement based on their personal credit history. You are led to believe that the massive banking institution rigorously evaluated your specific credit profile, looked at your documented employment income, and offered a standardized, non-negotiable interest rate that accurately reflects your lending risk. You trust the printed document sliding across the desk because it looks highly official, generated by a sophisticated enterprise computer system, and presented by a friendly finance manager wearing a professional suit. But what if the entire structure of that interest rate is an intentional, highly engineered illusion? What if the rate printed on your legally binding contract has absolutely nothing to do with the actual rate the bank approved you for, and everything to do with a hidden, completely unregulated profit margin designed specifically to drain your bank account without your explicit knowledge? There is a highly guarded, secret number inside every single dealership transaction called the buy rate, and the difference between that hidden number and the number you actually sign for is going to absolutely shock you. When you finally sit down in the dealership finance and insurance office, commonly known throughout the industry as the F&I office, the manager takes your completed credit application and submits it electronically to a vast network of lending institutions. These lenders, ranging from massive national banks to specialized regional automotive financiers, immediately evaluate your personal FICO auto score, your documented debt-to-income ratio, and your historical employment stability. Based on rigorous historical trends and highly complex algorithmic risk assessments, the bank responds to the dealership with a wholesale interest rate. This specific percentage is the buy rate. It is the absolute lowest cost of capital the bank requires to safely finance your specific vehicle, given your exact risk profile. But the finance manager does not slide a piece of paper across the desk showing you this true buy rate. Instead, they legally mark up that interest rate before presenting you with the final contract. This controversial practice is known in the automotive sales industry as the dealer reserve or the dealer markup. If the banking institution offers a wholesale buy rate of exactly 6%, the dealership will frequently present you with a legally binding contract displaying a retail interest rate of 8 or 9%. That mathematical difference is not going to the lending institution to pay down your principal or cover banking administration costs. It goes directly into the dealership's pocket as a hidden, completely unregulated commission structure. Let us look at a highly specific case study taking place right now in the economic climate of 2026. Imagine a consumer named Michael, a dedicated civil engineer living in the state of Texas. Michael has spent the last decade meticulously building his credit score to an impressive 800. He spends hours negotiating the physical price of a reliable, $45,000 pickup truck on the showroom floor. Exhausted but victorious, he is ushered into the F&I office. The manager submits his application to a major national bank. Because of his pristine credit profile and solid income, the bank instantly returns a highly competitive buy rate of 5.5%. However, the finance manager looks at Michael, realizes he has not done his necessary due diligence to secure pre-approved outside financing, and makes a calculated decision to mark the interest rate up to 7.5%. Michael looks at the 7.5% rate printed on the digital screen. Because he is unaware of the hidden buy rate, and because 7.5% sounds somewhat reasonable for the current national average, he signs the 72-month contract without a second thought. Let us meticulously break down the mathematical destruction caused by that invisible 2% markup. On a $45,000 principal stretched over 72 months at the true wholesale buy rate of 5.5%, Michael would have paid approximately $7,900 in total interest. But at the manipulated 7.5% retail contract rate, his total interest obligation violently skyrockets to over $11,000. By simply adding 2 percentage points to a digital document, the finance manager silently extracted over $3,000 of Michael's future wealth. This brings us to a harsh, unavoidable reality regarding the modern automotive sales floor. The professional sitting behind the large desk in the F&I office is not a neutral financial advisor, and they are legally not bound by any fiduciary duty to protect your financial interests. They are consistently the most highly trained, highest-earning sales professionals in the entire commercial building. Their primary objective is to generate massive back-end profit. Front-end profit is the money made on the physical metal, which is the negotiated price of the vehicle itself. Back-end profit is generated entirely through financing manipulations and the strategic inclusion of high-margin add-on products. The dealer reserve is the absolute crown jewel of this back-end profit ecosystem because it requires zero physical inventory, involves zero physical labor, and remains completely invisible to the uneducated American consumer. You might be wondering how this deceptive process is perfectly legal across the United States. It is legal because of the structural mechanics of indirect lending. When you finance a vehicle through a dealership, the dealership is legally acting as the original creditor. They originate the loan contract directly with you at the higher, marked-up retail rate. The moment you drive off the lot, they immediately assign or sell that legally binding contract to the banking institution. The bank purchases the contract from the dealership at the lower buy rate, and the dealership keeps the lucrative spread as their compensation for facilitating the loan. This massive structural loophole allows the dealership to act as an unregulated middleman, charging a staggering premium simply for the convenience of signing paperwork in their office rather than at a local bank branch. The physical environment of the F&I office is meticulously engineered to break down your psychological defenses and facilitate this exact wealth transfer. By the time you finally reach this small, isolated room, you have likely already spent 4 to 6 hours test driving, negotiating the front-end price, and waiting endlessly in the public lobby. You are actively experiencing severe decision fatigue. You are hungry, mentally drained, and emotionally invested in taking the new vehicle home to your family. The finance manager leverages this deep psychological exhaustion. They present the final numbers on a complex digital touchscreen or a dense matrix of paper documents, deliberately focusing your attention entirely on the monthly payment rather than the total cost of the capital over time. They will use carefully scripted language, stating they fought hard to get you approved for only $700 a month, completely ignoring the fact that they stretched the loan term to 84 months and aggressively marked up the interest rate to maximize their personal commission check. The only mathematical defense against the dealer reserve is completely removing the dealership's ability to control your financing options. This requires a mandatory, non-negotiable step: securing an independent auto loan pre-approval from a local credit union or a community bank before you ever set foot on the dealership property. You must submit your application directly to an institution where you are a member, allowing them to underwrite your loan based on their transparent, published rates. When you walk into a dealership with a certified pre-approval letter locking in a direct rate, you instantly strip the F&I manager of their primary financial leverage. You fundamentally transform from a vulnerable monthly payment buyer into a powerful cash equivalent buyer. If the dealership wants to earn your financing business and receive a kickback from their network of lenders, they must mathematically beat your pre-approved rate in writing, effectively forcing them to offer you the true buy rate without their hidden, predatory markup. However, the exact moment you declare to the salesperson that you have your own independent financing secured, the dynamic of the negotiation violently shifts. The dealership management immediately recognizes they have just lost thousands of dollars in potential back-end profit. Because modern dealership profit margins are heavily dependent on capturing your financing, they have developed aggressive, highly structured countermeasures specifically designed to neutralize your credit union pre-approval. They will utilize complex psychological pressure, financial misdirection, and carefully worded legal documents to trick you into abandoning your secured funds. They might even allow you to sign the initial paperwork and drive the car home that very night, looking you in the eye and assuring you everything is perfectly handled, only to call you frantically 3 days later demanding you return the vehicle to the lot immediately because the financing mysteriously fell through. This terrifying and highly coordinated tactic is known throughout the industry as the yo-yo auto sale, or spot delivery. It is structurally designed to trap you in a desperate, highly emotional situation where you feel legally forced to sign a brand new contract at a significantly higher interest rate just to keep the car sitting in your driveway. The exact mechanical steps of how this devastating trap is sprung, the specific legally binding documents you must absolutely refuse to sign, and the exact script you need to read to the general manager to shut this scam down immediately is precisely what we are going deeply into next. The spot delivery, frequently referred to in consumer protection circles as the yo-yo scam, is one of the most psychologically devastating tactics utilized in the modern automotive industry. It preys on the emotional high of taking a new vehicle home and weaponizes the ensuing embarrassment of having that vehicle taken away. Here is the exact mechanical breakdown of how this trap is executed. You walk into the dealership with your pre-approval letter from your local credit union. The finance manager looks at your approved rate of 5% and smiles, stating they can actually beat that rate or process the credit union paperwork directly through their own systems to save you a trip. Because it is late on a Saturday evening or a Sunday when banks are strictly closed, they cannot get the final official approval from the lending institution. However, they tell you not to worry. They print out a massive stack of legally binding documents, assure you everything is perfectly in order, and hand you the keys. You drive the car home, show your family, and park it in your driveway. You are operating under the absolute assumption that you own this vehicle, and the financial transaction is permanently closed. Consider a historical trend case study applicable to the current 2026 automotive market. Imagine a consumer named Emily, a public school teacher residing in Florida. Emily spent months saving a $4,000 cash down payment and traded in her older sedan, which the dealership valued at $3,000. She drove off the lot on a Saturday night with a brand new mid-sized SUV, believing she secured a 60-month loan at 6% interest. Fast forward exactly 5 days to Thursday afternoon. Emily is sitting in her classroom when her phone rings. It is the dealership finance manager, and his tone has completely changed from friendly to highly urgent. He informs Emily that there was a problem with the underwriting process. He claims the bank unexpectedly rejected the specific loan structure due to a sudden shift in her debt-to-income ratio, or perhaps a minor discrepancy in her employment verification. He states firmly that the financing fell through, and she must return to the dealership immediately to sign new paperwork, or face having the vehicle aggressively repossessed. Emily panics. She has already shown the car to her friends, her old car is gone, and her cash is in the dealership bank account. When she rushes back to the finance office, the manager presents a completely new contract. Magically, the new annual percentage rate is no longer 6%. It has skyrocketed to 11%, and the loan term has been stretched to 72 months to keep the monthly payment somewhat similar. If Emily signs this new document, she will pay thousands of dollars more in hidden interest over the life of the loan. The dealership engineered this entire crisis specifically to force her into a highly profitable subprime contract that they will immediately sell to a secondary lender for a massive commission check. How did the dealership legally allow Emily to drive away in a $30,000 asset without actual payment? Buried deep within the original stack of Saturday night paperwork was a highly specific, easily overlooked document called a spot delivery agreement, also legally known in various jurisdictions as a bailment agreement or a rescission agreement. By signing this single piece of paper, Emily legally agreed that the sale was entirely conditional upon final bank approval. The document explicitly states that if the dealership cannot secure financing at the exact terms listed on the initial contract, the sale is null and void, and Emily is legally acting as a mere borrower of the dealership vehicle. She essentially signed a temporary rental agreement disguised as a purchase contract. This is where consumer financial education becomes your absolute ultimate defense. If you ever find yourself receiving this terrifying phone call, you must immediately separate your emotions from the mathematical and legal reality of the situation. Your first step is to recognize that you possess significantly more leverage than the dealership wants you to believe. Do not negotiate new loan terms over the telephone, and absolutely do not agree to a higher interest rate out of fear. You must return to the dealership in person, bring the vehicle keys, and prepare to execute a highly specific exit strategy. When you sit down with the general manager, not the original salesperson, you must utilize a strict, unemotional script based on your legal rights. You state clearly and firmly that you understand the original conditional contract is now legally void because they failed to secure the agreed-upon financing. You explicitly inform them that you do not accept their new, heavily marked-up counteroffer. Therefore, you are returning their property, and you demand the immediate full return of your exact cash down payment and the physical return of your trade-in vehicle. The dealership management will instantly panic. They will deploy severe pressure tactics, claiming they have already sent your trade-in vehicle to a wholesale auction, or that your cash deposit is locked in a non-refundable corporate account. These are almost always fabricated statements designed to break your resolve. In nearly all state jurisdictions, if a conditional spot delivery falls through and the consumer rejects the new terms, the dealership is legally mandated to unwind the entire transaction completely. They must return your down payment in full. If they actually did sell your trade-in vehicle, which is highly illegal before the new loan is fully funded and finalized, they are legally obligated to cut you a check for the absolute full negotiated value of that trade-in immediately. If the general manager refuses to unwind the deal and attempts to hold your money hostage, you immediately inform them that you will be contacting your state attorney general office, the local Department of Motor Vehicles Dealer Licensing Board, and the Consumer Financial Protection Bureau to file formal complaints regarding deceptive spot delivery practices. In the vast majority of historical case studies, simply mentioning the State Dealer Licensing Board forces the dealership to instantly produce your down payment check and your trade-in keys. They cannot risk a massive state audit or the potential suspension of their lucrative license to sell vehicles over one single transaction. Surviving the spot delivery trap and securing your own independent financing at a true wholesale buy rate is only the first major battle in the war to protect your net worth. Even if you successfully navigate the interest rate matrix and secure a mathematically sound loan structure, the finance manager has one final, highly destructive arsenal waiting for you at the very end of the paperwork process. They are going to attempt to silently inject thousands of dollars of heavily marked up, mathematically devastating add-on products directly into your newly secured loan principal. These products are presented not as optional purchases, but as mandatory protective shields for your financial future. They will look you in the eye and warn you that without these specific policies, a single mechanical failure or a total loss accident will completely bankrupt your family. We are going to meticulously dissect the exact mathematical reality of guaranteed asset protection, extended powertrain warranties, and prepaid maintenance plans to reveal exactly which ones are potential lifesavers and which ones are pure, unadulterated financial poison designed to silently drain your wealth over the next 72 months. The moment you successfully decline the marked-up interest rate, the finance manager pivots to a highly structured psychological sales tactic known throughout the automotive industry as menu selling. They will slide a legally intimidating document across the desk, or more commonly in 2026, turn a large digital tablet toward you. This screen will display 3 or 4 distinct protection packages, typically labeled with aggressive, tiered names like Basic, Gold, and Platinum. The human brain is psychologically hardwired to avoid extremes, meaning most consumers will naturally gravitate away from the cheapest, bare-bones option and away from the overwhelmingly expensive Platinum option, instinctively settling for the middle Gold package simply because it feels like a safe, reasonable compromise. This is a highly engineered cognitive bias trap. The dealership does not actually care which package you choose, because every single item listed on that menu represents massive, largely unregulated back-end profit. Let us deeply examine the most common and controversial item on this menu: guaranteed asset protection, universally known as gap insurance. To understand gap, we must revisit the brutal mathematical reality of vehicle depreciation. Imagine if a consumer named Robert, a warehouse supervisor living in modern-day 2026 Ohio, purchases a brand new pickup truck for $45,000. Because Robert did not provide a substantial cash down payment, his total loan amount, including state taxes and dealership documentation fees, is exactly $49,000. Historically, a new vehicle loses approximately 20% of its market value the instant the tires cross the dealership property line. 6 months later, Robert is driving on the highway and is involved in a severe multi-vehicle collision. The truck is completely destroyed. Robert's primary auto insurance company evaluates the current actual cash value of the destroyed truck and determines it is only worth $36,000 on the open market. They send a check for $36,000 to his lending institution. However, because Robert is only 6 months into a 72-month loan, his principal balance has barely decreased. He still owes exactly $47,000 to the bank. This creates a terrifying $11,000 negative equity gap. Without gap coverage, the lending institution immediately converts that $11,000 deficit into an unsecured personal loan, and Robert is legally obligated to pay it out of pocket, while simultaneously having no vehicle to drive to work. In this highly specific scenario, gap coverage is an absolute financial lifesaver because it is legally designed to pay off that exact $11,000 difference, entirely clearing the debt. Therefore, the finance manager will look Robert in the eye, recount a similar horror story, and strongly advise him to purchase the dealership gap policy for a flat fee of $1,200. What the finance manager deliberately omits is the fatal mathematical flaw in how this specific transaction is structured. If Robert agrees that $1,200 is not paid in cash, it is immediately rolled into his existing $49,000 loan principal. At a standard 8% annual percentage rate stretched over 72 months, Robert is not paying $1,200 for gap coverage. After compound interest is systematically applied, he will actually pay close to $1,600 for that exact same policy. The true financial poison here is not the concept of gap itself, but the distribution channel. If Robert had simply picked up his smartphone while sitting in the dealership lobby and called his primary auto insurance provider, he could have legally added a gap endorsement to his existing monthly insurance policy for approximately $30 to $50 a year. Over the critical first 3 years of the loan, when the negative equity risk is at its absolute highest peak, Robert would have paid a maximum of $150 for the exact same protective coverage that the dealership just sold him for $1,600. The dealership relies entirely on your lack of external market awareness to facilitate this massive wealth transfer. Next on the menu, we must dissect the extended vehicle service contract, aggressively marketed to consumers as an extended powertrain or bumper-to-bumper warranty. The pitch is deeply rooted in financial fear. The manager will correctly point out that modern vehicles in 2026 are essentially highly complex rolling computer networks. They will cite historical trends showing that replacing a single infotainment screen or a specialized transmission control module can easily cost $3,000 to $4,000 in out-of-pocket labor and parts. They present a comprehensive platinum warranty for $3,500, framing it as the ultimate shield against future catastrophic repair bills. The mechanical reality of these contracts is astonishingly weighted against the consumer. First, these are rarely warranties backed by the actual vehicle manufacturer. They are typically third-party service contracts administered by massive, private risk management corporations. When you roll that $3,500 contract into an 84-month loan at a 9% interest rate, the total amortized cost of that warranty balloons to over $5,000. You are actively paying compound interest on a service you may never actually use. Furthermore, the legal fine print of these third-party contracts is systematically designed to deny claims based on highly technical technicalities. If your transmission fails in year 4, the claims administrator will demand a complete, documented service history proving you changed the transmission fluid at the exact mileage intervals specified in the manual. If you missed a single fluid change by 1,000 miles, or if you performed the maintenance yourself in your garage without a certified commercial receipt, they will legally void the contract and deny the claim entirely. You are left paying $5,000 to the bank for a piece of paper that refuses to cover your $4,000 mechanical repair. Finally, we reach the most mathematically absurd category of dealership add-ons: prepaid maintenance plans and cosmetic protection packages. These include expensive nitrogen tire fills, interior fabric guard sprays, ceramic paint coatings, and prepaid oil change bundles. Let us examine the prepaid oil change package, typically priced around $800 for 3 years of scheduled maintenance. The finance manager frames this as a brilliant hedge against future inflation, locking in today's service prices. However, when you finance $800 at 9% interest over 6 or 7 years, you are fundamentally prepaying for a service you will not receive for 36 months, while allowing a lending institution to charge you daily interest on that exact money. You are borrowing expensive money from a bank to pay a dealership in advance for motor oil. From a strict wealth-building perspective, it is infinitely more logical to decline the package, keep your loan principal as low as mathematically possible, and simply pay a local independent mechanic out of your cash flow when the vehicle actually requires routine maintenance. By meticulously stripping away the marked-up interest rates, successfully neutralizing the spot delivery trap, and ruthlessly declining the mathematically destructive menu add-ons, you have officially navigated the primary franchise dealership matrix. You have protected your household income and structured a fundamentally sound, simple interest auto loan. But what happens if the traditional banking system completely rejects your application? What if your personal FICO auto score has been severely damaged by historical medical debt, a previous bankruptcy, or a sudden job loss, and you cannot even get through the front doors of a standard franchise dealership? This forces millions of hardworking Americans into the dark, highly unregulated shadows of the subprime auto market. In this specific ecosystem, the mathematical rules we just established are completely rewritten, and the vehicles themselves are frequently equipped with hidden GPS trackers and remote start or interrupt devices, allowing the dealer to literally shut off your engine while you are driving down the highway if you miss a payment by a single hour. The terrifying mechanics of the buy here, pay here industry, the predatory reality of deep subprime tiering, and how to successfully escape this specific cycle of systemic poverty is exactly what we must uncover next. To understand the subprime auto market in 2026, you must first understand that traditional lending institutions view your financial history through a highly specific, stratified lens called the credit tier system. Every single consumer is categorized into one of 5 distinct brackets based on their specialized auto industry credit score. These complex tiers range from super prime, which represents an impeccable credit history and commands the absolute lowest interest rates, down through prime, non-prime, subprime, and finally deep subprime. When a consumer experiences a catastrophic financial event, such as an unexpected medical emergency, a prolonged period of unemployment, or a finalized legal bankruptcy, their score plummets rapidly into the deep subprime category. At this specific numerical level, massive national banks and standard credit unions fundamentally refuse to underwrite any standard auto loan. They view the statistical probability of default as mathematically unacceptable and strictly avoid the risk. This systemic rejection effectively locks millions of hardworking Americans entirely out of the traditional franchise dealership ecosystem, forcing them to seek daily transportation in the highly predatory, alternative universe of the buy here, pay here business model. The buy here, pay here model is structurally inverted compared to everything we have discussed previously in this masterclass. In a standard retail transaction, the dealership sells the vehicle, and a completely separate banking institution provides the capital. In a buy here, pay here transaction, the dealership and the bank are the exact same physical entity. They do not utilize indirect lending, and they absolutely do not sell your legally binding contract to a secondary financial institution. They physically hold the debt note in their own office filing cabinets. Because they are financing the vehicle internally with their own private capital, they assume 100% of the financial risk. To mitigate this extreme risk exposure, they deploy a comprehensive business strategy built on staggering vehicle markups, maximum allowable state interest rates, and aggressive technologically enforced repossession tactics. The mathematical reality of this specific ecosystem is not designed to help you successfully pay off a depreciating asset over time. Historical trends heavily suggest it is meticulously engineered to ensure you ultimately default, allowing the dealership to repossess the vehicle and sell it again for maximum profit to the next vulnerable consumer. Let us examine a highly detailed case study set right now in the current economic landscape of 2026. Imagine a consumer named John, a dedicated restaurant manager living in Detroit, Michigan. Due to a recent divorce and subsequent overwhelming legal fees, John's credit score has dropped to an incredibly precarious 510. However, John absolutely must have a reliable vehicle to commute across the city to his job and maintain his household income. He carefully gathers $2,000 in liquid cash and visits a local buy here, pay here lot. The physical environment is completely different from a pristine franchise dealership. There are no massive glass showrooms, complimentary coffee bars, or dedicated service centers. The vehicles sitting on the gravel lot are typically older, high-mileage sedans purchased at wholesale subprime auto auctions for mere pennies on the dollar. John finds a 12-year-old compact car that appears to run reasonably well. He sits down with the dealer to discuss the financial terms, and this is where the mathematical destruction permanently begins. The independent dealer quietly knows they purchased this specific 12-year-old vehicle at a wholesale auction just 3 weeks ago for exactly $2,500. But because John has deep subprime credit and zero alternative financing options available in the traditional market, the dealer sets the retail sticker price on the windshield at an astonishing $9,000. When John hands over his $2,000 cash down payment, he has nearly completely reimbursed the dealer for their initial capital investment in the physical metal. The remaining $7,000 principal balance is an entirely fabricated, high-margin profit zone. But the dealer is not finished extracting wealth. Because they are legally acting as the banking institution, they apply an annual percentage rate that pushes the absolute upper boundary of state usury laws. In many local jurisdictions, this interest rate can legally range from 24% to a devastating 29%. John is now mathematically trapped in a high-interest loan on a severely overpriced, rapidly depreciating asset that is already past its mechanical prime. To enforce this incredibly fragile financial arrangement, the buy here, pay here industry utilizes highly advanced, deeply intrusive surveillance technology. Before John is legally permitted to drive the vehicle off the lot, a lot mechanic permanently wires a specialized piece of hardware directly into the ignition system of the car. This hardware contains a real-time global positioning system tracker and a remote starter interrupt device. This is not a passive security feature designed to prevent theft. It is an active, aggressive enforcement mechanism controlled entirely by the dealership software system. To further compound the difficulty, many of these dealerships demand physical, in-person weekly payments made entirely in cash, intentionally creating massive friction and increasing the probability of a missed deadline. If John's cash payment is due on a Friday afternoon, and he fails to make the transaction by the precise close of business, the dealership does not send a polite reminder letter in the mail. They simply log into a digital dashboard on their office computer and click a button. The very next time John attempts to turn his key in the ignition, the engine will be completely dead. The starter interrupt device physically blocks the electrical current from reaching the engine block. Imagine the potential outcomes of this terrifying level of technological control. John could be stranded in a freezing parking lot at midnight, completely unable to start his vehicle, entirely because his paycheck cleared the bank one day late and he missed his payment window by a matter of hours. He is fundamentally stripped of his basic autonomy. If John cannot immediately produce the required payment, plus a heavy administrative late fee to electronically unlock the ignition, the dealership will use the active GPS tracker to perfectly locate the disabled vehicle and send a specialized tow truck to repossess it in the middle of the night. This specific repossession process is exactly what the buy here, pay here business model anticipates and actively encourages. Once the car is towed back to the lot, the dealership legally keeps John's original $2,000 down payment. They keep every single weekly cash payment he managed to make, and they immediately put the exact same 12-year-old compact car right back on the front line to sell to another vulnerable consumer on Monday morning. Case studies across the automotive industry reveal that some high-volume buy here, pay here lots routinely sell, repossess, and resell the exact same physical vehicle 5 or 6 times in a single calendar year, generating exponential, compounding profit from a single low-value asset. This brutal cycle of predatory pricing, constant electronic surveillance, and systematic repossession traps millions of consumers in a permanent state of financial paralysis. When you are dedicating 40% of your monthly household income to a 29% interest loan on a car that might suffer a catastrophic transmission failure at any moment, you have absolutely zero capital left over to build an emergency fund, invest for the future, or repair your severely damaged credit profile. You are merely surviving week to week, paying exorbitant daily interest simply for the privilege of driving to work to earn the money to pay the dealer. But what if you are already trapped inside one of these mathematically devastating contracts right now? What if you are sitting at home watching this masterclass, staring at a high-interest auto loan document with a remote kill switch installed underneath your dashboard, feeling completely hopeless about your financial future? There is a highly specific, legally binding exit strategy. It requires a rigorous, multi-step credit rehabilitation timeline, the strategic utilization of specialized community credit unions, and a precise mathematical formula to force a refinance transaction, even when you are severely underwater on the principal balance. The exact blueprint to permanently break the chains of subprime automotive debt and legally force the banking system to lower your interest rate is exactly what we are going to meticulously construct next. The very first step in executing a successful subprime escape strategy is understanding that you are entering a highly disciplined, strictly mathematical incubation period. When you first sign a predatory contract at a buy here pay here lot, you cannot simply walk into a traditional bank the following Monday and ask for a better interest rate. The traditional banking system already rejected your credit profile, which is precisely why you were forced into the subprime market to begin with. To legally force a massive financial institution to absorb your auto loan and lower your annual percentage rate, you must physically prove to them that their initial automated risk assessment was mathematically incorrect. Based on historical trends in the automotive refinancing sector, this mandatory incubation period typically requires a minimum of 6 to 12 months of absolute, flawless payment history. During this critical window, your auto loan payment must become the single highest financial priority in your household budget, superseding every other unsecured debt you carry. To understand why this specific payment history is so vital, you must comprehend the structural difference between your general consumer credit score and your highly specialized FICO auto score. When a traditional bank evaluates a standard credit card application, they look at your overall utilization and general payment history across various accounts. However, when an underwriter reviews an auto refinance application, they pull a specific algorithmic model that heavily isolates and magnifies your historical performance strictly on automotive installment loans. A single missed payment on a vehicle loan is catastrophic to this specific metric. Conversely, a documented string of consecutive, on-time payments made to a subprime automotive lender acts as an incredibly powerful rehabilitative tool. By executing exactly 6 to 12 months of perfect payments, you are rapidly artificially inflating your FICO auto score, transforming your data profile from a deep subprime risk into a prime refinancing candidate. Let us examine a highly detailed case study set right now in the current economic landscape of 2026. Imagine if a consumer named Michael, a delivery route driver operating in Atlanta, Georgia, is currently trapped in a mathematically devastating subprime contract. Michael purchased a reliable but aging 2016 commuter sedan from a local independent lot. Because of a previous period of sustained unemployment, his credit score was severely depressed. The independent dealer financed the vehicle at a staggering 26% annual percentage rate. Michael currently owes $14,000 on the principal balance. After 8 months of aggressive budgeting and working mandatory overtime shifts, Michael has never missed a single weekly payment. His specialized auto credit score has steadily recovered, and he feels entirely ready to visit a local bank to escape his massive interest rate. However, Michael is about to crash directly into the second, and mathematically most difficult barrier of the refinancing process. This barrier is known as the loan-to-value ratio, universally referred to in the financial sector as LTV. The loan-to-value ratio is the exact mathematical relationship between your current outstanding loan principal and the true, depreciated wholesale auction value of your physical vehicle. Traditional lending institutions have strict, non-negotiable legal limits on the maximum LTV they are willing to finance. In standard market conditions, a conservative bank will outright reject any refinance application if the loan exceeds 120% of the vehicle value. Let us apply this rigid mathematical formula to Michael's specific situation in Atlanta. The traditional bank utilizes a standard industry valuation tool and determines that the wholesale actual cash value of his 2016 sedan has depreciated significantly and is now worth exactly $9,000 on the open market. The bank multiplies that $9,000 valuation by their maximum allowable limit of 120%. This calculation reveals that the absolute maximum amount of capital the bank is legally permitted to lend Michael against that specific vehicle is $10,800. But Michael still owes exactly $14,000 to the predatory buy here pay here lot. He is trapped in a massive negative equity position of $3,200. Even with his vastly improved credit profile and perfect payment history, the automated banking software will instantly reject his refinance application because the collateral does not justify the requested loan amount. To successfully bridge this negative equity gap and satisfy the strict mathematical requirements of the underwriting software, Michael must execute a highly aggressive, targeted paydown phase. During his initial incubation period, he cannot simply make his standard weekly payments, because a massive percentage of those payments is being entirely consumed by the 26% daily interest charges, leaving his principal balance virtually untouched. He must accumulate excess capital and make highly specific, strategically deployed micropayments directed entirely at the loan principal. But this requires extreme caution and meticulous documentation. Many predatory subprime lenders will intentionally misallocate extra cash payments, applying the funds to future, unearned interest rather than reducing the core principal balance. To legally prevent this wealth extraction, Michael must formally demand that the extra funds be applied strictly as principal-only payments, and he must rigorously verify that his subsequent billing statements reflect the exact, accelerated reduction of his $14,000 balance. Once Michael successfully aggressively pays down his principal balance to mathematically align with the bank's required loan-to-value ratio, he must choose his new lending institution with extreme strategic precision. He absolutely should not apply at a massive, impersonal national megabank. Their underwriting processes are entirely algorithmic, meaning a computer software program will make the final decision with zero human context. Instead, the optimal potential outcomes for subprime refinancing are almost exclusively found within localized, community-chartered credit unions. Credit unions operate under a fundamentally different legal and structural model than traditional, for-profit commercial banks. They are nonprofit financial cooperatives owned directly by their members, and their primary mandate is to serve the local community rather than extract maximum shareholder dividends. Most importantly, local credit unions employ human loan officers who physically review complex applications. They can manually evaluate Michael's consecutive pay stubs, verify his specialized job stability, and recognize his sheer discipline in completing 8 months of flawless payments on a punishing 26% interest loan. When the credit union loan officer manually approves the refinance application, a highly satisfying financial transaction is legally triggered. The credit union will draft a certified check for the exact remaining payoff balance and physically mail it directly to the buy here pay here lot. The original subprime dealer is then legally mandated by state financial regulations to accept the funds, officially close out the toxic 26% interest account, and release the property lien. Michael now holds a newly originated, mathematically sound, simple interest auto loan with his local credit union at an exponentially lower rate of 7%. The moment that original lien is legally released and the new title is issued to the credit union, Michael can drive his 2016 sedan directly to an independent, certified automotive technician. He can hand the technician the keys and legally authorize them to crawl under the dashboard, locate the hidden global positioning system tracker, find the remote starter interrupt device, and physically rip the predatory hardware entirely out of his vehicle. He has officially broken the cycle, mathematically protected his future household income, and reclaimed his personal autonomy from the subprime ecosystem. But this entire intricate escape blueprint relies entirely on one terrifying, highly fragile assumption. It assumes that the heavily depreciated, high-mileage vehicle you originally purchased from the subprime lot actually survives the critical 6 to 12-month incubation period without suffering a catastrophic mechanical failure. What happens to your financial strategy if, in month 4 of your perfect payment history, the engine block suddenly cracks, the transmission completely fails, or the vehicle simply refuses to start, leaving you with an $8,000 repair bill you absolutely cannot afford, a vehicle that cannot be legally driven on the highway, and a high-interest loan that must still be paid every single Friday? Navigating the absolute nightmare scenario of a massive mechanical breakdown, while actively trapped upside down in a predatory subprime loan, requires a completely different set of aggressive survival tactics, and that exact operational protocol is what we must dissect immediately. When a catastrophic mechanical failure occurs on a heavily financed subprime vehicle, the mathematical crisis instantly accelerates into a severe legal and logistical nightmare. To fully understand the gravity of this situation in the current automotive landscape of 2026, we must analyze the exact legal framework governing used vehicle sales in the United States. Almost every single vehicle sold on a buy here pay here lot or an independent subprime dealership is sold under a highly specific legal designation known as as-is. The Federal Trade Commission strictly requires dealers to display a standardized buyer's guide window sticker on all used vehicles, and in the vast majority of subprime transactions, The massive box labeled as "is no dealer warranty" is prominently checked. This is not merely a casual suggestion. It is an ironclad legal shield protecting the dealership. When you sign the final purchase contract containing an as-is clause, you are legally accepting 100% of the financial liability for all future mechanical defects, even if the engine literally explodes on your drive home from the dealership. Consider a detailed case study involving a consumer named David, a warehouse logistics manager living in Pennsylvania. David is currently 4 months into a punishing 28% interest subprime loan on a 2015 sport utility vehicle. He owes $11,000 on the principal balance. One morning on his commute to the warehouse, the vehicle transmission completely shreds its internal gears. The SUV is towed to an independent mechanic, who delivers a devastating repair estimate of $4,500. David does not have $4,500 in liquid emergency savings. He contacts the subprime dealership, hoping they will offer assistance, but the finance manager calmly refers him directly to the as-is clause in his signed contract. The dealer explicitly informs David that his regular weekly payment of $150 is still due on Friday, regardless of whether the vehicle is currently drivable or sitting on a mechanic lift with no transmission. David is now facing the ultimate sunk cost fallacy, and his potential outcomes are uniformly brutal. He cannot legally sell the broken vehicle to a private party or a scrapyard because the subprime lender physically holds the legal title and maintains an active lien against the asset. If he attempts to secure a high-interest payday loan or title loan to cover the transmission repair, he will be stacking a secondary predatory debt directly on top of his primary predatory auto loan, mathematically guaranteeing a systemic household default within weeks. This leaves David staring at the most terrifying option in the consumer automotive space: the voluntary surrender, frequently referred to as a voluntary repossession. There is a massive, incredibly dangerous misconception circulating among American consumers that if you simply drive a broken, financially underwater vehicle back to the dealership lot, hand the keys directly to the manager and walk away, the loan contract is miraculously canceled and the debt is completely forgiven. This is mathematically and legally false. A voluntary surrender is treated by the banking system and the credit reporting bureaus exactly the same as an involuntary, middle-of-the-night tow truck repossession. The only difference is that you save the lending institution the operational cost of hiring a recovery agent to hunt the vehicle down. Let us meticulously break down the exact mathematical sequence that occurs the moment David drops the keys to his broken SUV on the dealership desk. The subprime lender legally accepts the vehicle, but they absolutely do not cancel the $11,000 principal balance. Instead, state commercial codes dictate that the lender must attempt to mitigate their financial losses by selling the recovered collateral at a wholesale auto auction. Because the vehicle currently has a destroyed transmission and cannot be driven across the auction block, it is classified as inoperable salvage. At the wholesale auction, scrap buyers and salvage rebuilders bid on the broken vehicle, and it ultimately sells for a mere $1,500. The lending institution takes that $1,500 and mathematically applies it to David's $11,000 principal balance. They also legally add the cost of the auction fees, standard storage fees, and administrative processing fees to his account. The resulting mathematical equation reveals that David still owes approximately $10,000 to the subprime lender. This remaining debt is known in the financial industry as a deficiency balance. Because the physical collateral has been sold and is no longer attached to the loan, that $10,000 deficiency balance instantly converts from a secured auto loan into an unsecured personal debt, and it becomes immediately due and payable in full. The dealer does not simply write off this $10,000 deficiency balance as a standard cost of doing business. Historical trends in the subprime market show that these institutions operate highly aggressive legal recovery departments. They will file a formal civil lawsuit against David in local county court for the full $10,000 plus escalating legal fees. Because David clearly signed the original contract and clearly failed to repay the principal, the judge will almost certainly rule in favor of the lending institution, granting them a devastating legal instrument called a deficiency judgment. With this judgment in hand, the subprime lender can legally deploy severe collection tactics against David. Depending on the specific state laws where he resides, the lender can systematically freeze his personal checking accounts, legally seize his future tax refunds, and aggressively garnish up to 25% of his gross weekly paychecks directly from his employer until the entire $10,000 debt is completely satisfied. David is now enduring wage garnishment for a decade-old SUV. He only drove for 4 months and no longer owns. To avoid this catastrophic legal outcome, some consumers attempt to negotiate a completely different, highly manipulative survival strategy directly with the subprime dealer. When David informs the dealer that the transmission is destroyed and he is contemplating voluntary surrender, the dealer might suddenly offer a seemingly miraculous solution. They will tell David to have the broken SUV towed back to their lot, and they will graciously allow him to trade it in for a different, functioning vehicle from their current inventory. They frame this as a massive favor, rescuing him from a vehicle without a transmission. However, this is not a rescue operation. It is a highly engineered mathematical trap known as rolling negative equity. The dealer knows the broken SUV is only worth $1,500, but David owes $11,000. That represents $9,500 of pure negative equity. The dealer takes a different vehicle from their lot, perhaps a high-mileage 2014 sedan that they purchased at auction for $3,000. They inflate the retail price of this sedan to $10,000. Then they silently take David's $9,500 of negative equity from the broken SUV and roll it directly into the new loan contract. David is completely exhausted, desperate to get to work, and hyper-focused solely on securing a drivable vehicle. He signs the new paperwork without running the amortization calculations. He has just mathematically bound himself to a nearly $20,000 loan principal at a 29% interest rate, entirely secured by a 2014 sedan that is physically worth only $3,000 on the wholesale market. The subprime dealer successfully trapped him in a deeper cycle of exponential debt, resetting the term length, doubling his principal exposure, and ensuring he will remain a highly profitable prisoner of their financial ecosystem for years to come. If voluntary surrender guarantees a devastating legal judgment, and rolling negative equity guarantees permanent financial paralysis, what is the actual strategic protocol when your subprime vehicle suffers catastrophic failure? The answer involves a highly complex, rarely discussed mechanism known as a formalized workout agreement, combined with an aggressive challenge to the origination paperwork itself. But executing this strategy requires understanding how debt is legally transferred, packaged, and sold in the secondary market. When a subprime lender realizes they are unlikely to collect a massive deficiency balance from a distressed consumer, they do not simply give up. They package your debt with thousands of other defaulted auto loans and sell the entire portfolio for pennies on the dollar to shadowy, third-party junk debt buyers. These aggressive collection agencies operate in a completely different legal reality, utilizing psychological warfare and legally questionable tactics to force you to pay. Understanding exactly how to intercept these third-party debt buyers, legally demand original contract validation, and permanently delete a phantom auto deficiency from your credit report is the ultimate defensive weapon you must possess, and we are going to tear down that exact legal framework next. The secondary debt market is a multi-billion-dollar shadow industry that thrives entirely on consumer ignorance and psychological intimidation. When a subprime lender realizes that extracting a $10,000 deficiency balance from a financially exhausted consumer is mathematically improbable, they utilize a highly specific financial maneuver. They bundle your specific auto loan deficiency together with thousands of other defaulted contracts into a massive digital portfolio. They then sell this entire portfolio to a third-party junk debt buyer. These transactions do not happen at full value. Based on historical trends, debt buyers purchase these portfolios for mere pennies on the dollar. A junk debt buyer might pay only $400 to legally acquire the right to collect your $10,000 deficiency balance. The mathematical profit model here is staggering. Because they only paid $400 for your account, if they can deploy aggressive psychological warfare and convince you to set up a payment plan of just $100 a month, they break even in 4 months. Every single payment you make after that is pure, unadulterated profit. To achieve this, they utilize automated dialing systems, send legally intimidating letters on thick legal paper, and employ collection agents highly trained in linguistic manipulation. Let us look at a highly detailed case study set right now in the current economic landscape of 2026. Imagine a consumer named Jessica, a registered nurse living in the state of Ohio. 3 years ago, Jessica experienced a catastrophic engine failure on her financed subprime sedan and was forced into a voluntary surrender. She assumed the nightmare was over. Then, on a random Tuesday, she receives a terrifying letter from a massive national collection agency she has never heard of before. The letter demands immediate payment of $12,500, citing her old vehicle identification number, and threatens severe legal action if she does not call their toll-free number immediately to arrange a settlement. Jessica is panicked, but because she understands the legal framework of the Fair Debt Collection Practices Act, universally known as the FDCPA, she knows exactly how to respond. The absolute worst action Jessica can take is to call that toll-free number and speak to a collection agent on the telephone. The moment she engages in a verbal conversation, she risks accidentally acknowledging the debt, which in many state jurisdictions can instantly reset the legal statute of limitations, giving the collection agency brand new legal grounds to sue her. Instead, Jessica must execute a highly specific, legally binding defensive maneuver known as a formal demand for debt validation. Under Section 809 of the Fair Debt Collection Practices Act, every American consumer has the absolute federal right to demand that a third-party debt collector comprehensively prove their legal authority to collect the specific debt. When Jessica receives that initial collection letter, she has a strict 30-day window to respond in writing. She must draft a formal validation letter, print it on physical paper, and take it directly to the United States Post Office. She must send this document via certified mail with a return receipt requested. This creates a legally bulletproof paper trail proving exactly when the collection agency received her demand. Inside this validation letter, Jessica is not asking for a simple printout of an account balance. She is demanding rigorous legal documentation. She must demand the original contract bearing her physical wet ink signature. She must demand a complete, line-by-line accounting of the vehicle auction, including the exact date of the sale, the physical location of the auction, and the precise amount the vehicle sold for. Most importantly, she must demand the complete chain of custody documentation. This means the collection agency must produce legally binding assignment documents proving exactly how the debt was transferred from the original subprime dealership to any intermediate brokers, and finally to their specific collection agency. This is precisely where the junk debt buyer business model catastrophically fails. When these massive debt portfolios are bought and sold, they are typically transferred as giant digital spreadsheets containing thousands of names, social security numbers, and balance amounts. The physical, original paperwork is very rarely transferred because archiving and shipping thousands of original auto contracts is logistically expensive. Therefore, when Jessica legally demands to see the original signed contract and the strict chain of assignment, the collection agency almost certainly does not have it in their possession. Furthermore, the Uniform Commercial Code, which governs commercial transactions across the United States, requires that when a secured lender repossesses a vehicle and prepares to sell it at auction, they must send the consumer a highly specific, legally perfect document called a Notice of Intent to Sell. This notice must inform the consumer of the exact date, time, and location of the auction, giving them a final legal opportunity to attend the auction and bid on their own vehicle to minimize the deficiency. If the original subprime lender failed to send this notice, or if they sent it to the wrong address, or if the current junk debt buyer cannot physically produce a copy of this exact notice, the entire $12,000 deficiency balance is frequently rendered legally unenforceable in a court of law. By sending the certified validation letter, Jessica triggers a federal mandate. The collection agency is legally required to immediately cease all collection activity. They cannot call her, they cannot send her more letters, and they cannot file a civil lawsuit against her until they provide the requested physical documentation. If they cannot produce the original contract, the complete chain of custody, and the proper auction notices, they are legally paralyzed. They cannot prove they actually own the debt, and they cannot prove the mathematical validity of the balance. This leads directly to the ultimate weapon in consumer defense, the Fair Credit Reporting Act. If the collection agency cannot validate the debt according to federal law, they legally cannot report that unverified debt to the major credit bureaus. Jessica can take the return receipt from her certified mail, combine it with a copy of her validation demand, and file a direct dispute with the credit reporting agencies. She explicitly states that the collection agency failed to validate the alleged auto deficiency balance. Because the credit bureaus are legally mandated to maintain accurate information, and because the collection agency cannot provide the verifying documents, the credit bureaus must completely delete that massive $12,000 negative trade line from Jessica's credit profile. She has successfully utilized federal law to completely annihilate a phantom subprime auto debt. However, the moment you successfully force a collection agency to delete a deficiency balance, or the moment a statute of limitations officially expires, a completely new and potentially devastating financial mechanism is silently triggered behind the scenes. The lending institution, having completely lost their ability to collect the money from you legally, does not simply walk away empty-handed. They utilize a highly complex tax loophole to claim the loss on their own corporate tax returns. By doing this, they legally transition the burden of that unpaid debt directly from the private banking sector to the absolute most aggressive, powerful, and relentless collection agency on the entire planet, the Internal Revenue Service. The original lender will generate a specialized federal tax document called a 1099-C cancellation of debt form and mail it directly to the IRS. This form legally converts your canceled auto loan deficiency into taxable ordinary income, navigating the sudden, terrifying reality of a massive phantom tax bill, and utilizing the highly specific insolvency exclusion to legally defuse this tax bomb before it destroys your financial life, is the final, ultimate defense mechanism we must meticulously cover next. The moment a lending institution legally writes off a massive auto loan deficiency and fundamentally surrenders their ability to pursue you in civil court, they execute a highly strategic financial maneuver to recoup their losses at the expense of your federal tax profile. They exploit a specific provision within the United States Tax Code that allows corporations to claim uncollected debt as a financial loss, thereby reducing their own corporate tax burden. However, the Internal Revenue Service absolutely demands that every financial transaction balance precisely. If a multi-billion-dollar banking institution claims a $12,000 tax deduction by writing off your defaulted auto loan, the federal government mandates that someone else must legally claim that exact same $12,000 as taxable income. That someone is you. In late January or early February of the following tax year, you will visit your mailbox and find a terrifying, highly official document called an IRS Form 1099-C, explicitly designated for the cancellation of debt. To fully comprehend the catastrophic potential outcomes of receiving this specific document, you must understand the mathematical concept of phantom income. When the bank canceled your $12,000 auto deficiency, they did not physically hand you a briefcase filled with $12,000 in cash. You received absolutely zero liquid capital. Yet, according to strictly enforced federal tax law, the moment that debt is canceled, it is treated mathematically as if your employer suddenly handed you a $12,000 cash bonus. This discharged debt is legally classified as ordinary income, and it is forcefully added directly to the top of your standard wages for the year. This sudden, artificial inflation of your adjusted gross income creates a devastating financial shockwave. It can instantly push your household into a significantly higher tax bracket, completely disqualify you from critical income-based tax credits like the Earned Income Tax Credit, and artificially trigger phase-outs for vital deductions you desperately rely on to survive. Let us deeply analyze a highly specific case study taking place right now in the current tax year of 2026. Imagine a consumer named Marcus, an independent commercial truck dispatcher operating in the state of Illinois. 3 years ago, Marcus suffered a catastrophic medical emergency that completely drained his savings, ultimately forcing the voluntary surrender of a heavily financed family vehicle. The third-party collection agencies harassed him for years regarding a $15,000 deficiency balance, but because Marcus fundamentally lacked the liquid assets to pay, the collection efforts eventually ceased. Marcus believed the nightmare was permanently resolved. Then in the mail, Marcus receives a Form 1099-C formally declaring that the entire $15,000 debt has been completely discharged. Marcus earned exactly $50,000 dispatching trucks this year. But because of this single tax document, the Internal Revenue Service automated computer systems now view his annual income as $65,000. When he files his standard tax return, instead of receiving his anticipated $3,000 refund to help feed his family, the tax preparation software informs him that he legally owes the federal government a staggering $4,000 in unexpected income taxes. This is the exact definition of a tax bomb. If Marcus lacks extensive financial education, he might assume his only potential outcome is to desperately arrange a high-interest installment plan with the federal government, mathematically trading his predatory auto debt for an inescapable federal tax liability. But there is a powerful, highly specific, and entirely legal defense mechanism, deliberately built into the federal tax code to protect consumers exactly like Marcus. This mechanism is known as the insolvency exclusion, and it is executed by filing a highly complex document called IRS Form 982, legally titled the reduction of tax attributes due to discharge of indebtedness. To deploy this ultimate defensive weapon, you must strictly prove to the federal government that you were mathematically insolvent at the exact moment immediately preceding the cancellation of the debt. The Internal Revenue Service definition of insolvency is a strict, emotionless mathematical equation. It has absolutely nothing to do with filing for formal bankruptcy in a federal court. According to historical trends and established tax law, you are legally considered insolvent if your total liabilities completely exceed the total fair market value of your assets. To prove this, Marcus must meticulously construct a comprehensive insolvency worksheet, taking a hyper-accurate snapshot of his entire financial life on the exact day before the date listed in Box 1 of his 1099-C document. First, Marcus must rigorously calculate his total assets. A massive mistake uneducated consumers make here is utilizing the replacement cost of their personal items. The IRS does not care what you originally paid for your living room furniture 5 years ago. They require the current fair market value, which is essentially the exact amount of cash those items would generate if sold today at a neighborhood garage sale or an online classified marketplace. Marcus totals his meager checking account balance, the heavily depreciated garage sale value of his household furniture, his older electronics, and his basic work tools. His total calculated assets amount to a mere $4,000. Next, Marcus must calculate his total liabilities. This encompasses every single legally binding debt he owes to any institution or individual on that exact same date. This includes his current credit card balances, his outstanding federal student loans, his lingering medical debt, and most importantly, it absolutely includes the massive $15,000 auto loan deficiency that is about to be canceled. When Marcus adds his $15,000 auto debt to his $10,000 in student loans and his $5,000 in credit card debt, his total liabilities equal $30,000. Now, Marcus executes the final, critical mathematical formula. He subtracts his total assets, which are $4,000, from his total liabilities, which are $30,000. The resulting mathematical difference is $26,000. Therefore, Marcus is legally and mathematically insolvent by exactly $26,000. Because his proven insolvency of $26,000 is significantly greater than the $15,000 of canceled debt reported on the 1099-C. Federal tax law dictates that he is legally permitted to exclude the entire $15,000 from his taxable income. By properly attaching IRS Form 982 to his standard 1040 tax return and rigorously documenting his mathematical insolvency, Marcus completely defuses the tax bomb, legally drops his recognized income back down to his actual $50,000 in physical wages, and seamlessly protects his original tax refund. The absolute most dangerous action an American consumer can take is to look at a Form 1099-C, assume it is merely a complex clerical error, and intentionally throw it in the trash without reporting it. The Internal Revenue Service utilizes a massively powerful, completely automated digital infrastructure known as the Automated Underreporter System. When the lending institution generates that 1099-C, a digital copy is instantly transmitted directly to the federal government and permanently hard-coded to your specific Social Security number. If you file your standard tax return and fail to include that specific form or the corresponding Form 982 insolvency exclusion, the automated system will instantly flag the mathematical discrepancy. Approximately 12 to 18 months later, long after you have spent your tax refund, you will receive a devastating CP2000 notice in the mail. This notice will demand the immediate payment of the missing taxes, heavily compounded with aggressive failure to pay penalties and daily accruing interest, legally granting the government the authority to forcefully levy your bank accounts and garnish your wages to satisfy the newly created federal debt. By meticulously understanding the invisible mechanics of the dealer reserve, successfully neutralizing the psychological warfare of the spot delivery trap, mathematically rejecting the toxic menu of heavily inflated add-on products, legally navigating the catastrophic dangers of the subprime ecosystem, and finally deploying the ultimate federal tax exclusion to protect your household income from phantom debt cancellation, you have officially mastered the complex, multi-billion-dollar matrix of the American automotive lending industry. You have successfully defended your personal wealth from systematic, engineered extraction. You are no longer a vulnerable, financially illiterate monthly payment buyer. You are a strategic, mathematically grounded, cash-equivalent negotiator capable of protecting your family's future net worth. But now that you have successfully permanently eradicated this toxic debt from your financial profile and reclaimed hundreds of dollars in free monthly cash flow, a completely new, mathematically thrilling challenge instantly emerges. How do you aggressively redirect that exact newly freed capital to exploit the highly volatile, unprecedented interest rate environment of the 2026 economic landscape? the exact step-by-step algorithmic sequence required to systematically force the major credit bureaus to violently surge your FICO score by over 100 points in less than 30 days. Utilizing a highly guarded, legally compliant authorized user matrix is the absolute ultimate wealth-building mechanism we are going to rigorously decode in the very next masterclass.